Introduction of exchange rate of currency. An exchange rate is the value of one country's currency in relation to another country's currency. It represents the price at which one currency can be exchanged for another. Exchange rates are important because they affect the cost of goods and services in international trade, the value of foreign investments, and the competitiveness of a country's exports. There are two main types of exchange rates, fixed and floating. Fixed exchange rates are set by governments or central banks and are not allowed to fluctuate in response to market forces. In a fixed exchange rate system, the government or central bank may need to intervene in currency markets to maintain the exchange rate at the desired level. This can help provide stability for businesses and investors, but it can also lead to distortions in the economy and can be difficult to sustain over the long term. Floating exchange rates, on the other hand, are determined by supply and demand in currency markets. The exchange rate can fluctuate freely in response to market forces, such as changes in interest rates or shifts in economic growth. This can lead to greater volatility in exchange rates, but it also allows for greater flexibility in responding to changes in the economy. Overall, the choice of exchange rate system depends on a country's economic goals and the trade-offs between stability and flexibility. Two factors that affect exchange rates. Exchange rates are influenced by a variety of factors, including supply and demand for a currency. The exchange rate for a currency is determined by the supply and demand for that currency in the foreign exchange market. If the demand for a currency exceeds the supply, its value will increase relative to other currencies, and vice versa. Interest rates. Interest rates play a key role in determining exchange rates. Higher interest rates tend to attract foreign investment, which increases the demand for a currency and can drive up its value. Conversely, lower interest rates can lead to a decrease in demand for a currency and a decrease in its value. Inflation rates. Inflation, or the rate at which prices for goods and services increase over time, can also affect exchange rates. Higher inflation rates can erode the value of a currency and decrease its purchasing power, which can lead to a decrease in demand for that currency and a decrease in its exchange rate. Political and economic stability. Political and economic stability can affect exchange rates by influencing the confidence of investors in a country's economy. Countries with stable governments and economies are often seen as less risky and more attractive to foreign investors, which can increase the demand for their currency and raise its value.